Investing your first $100,000. What to do, where to invest, and what to buy right here, right now. Stay tuned. I'm Rob Tatro from robtatro.com, portfolio manager at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. Today, I'm really excited because I'm doing a video with my business partner and my sister, Tanya Tatro. Let's bring her in right away. Tanya, great to have you here.
So happy to be here. Thanks.
All right. So today we're talking about a very important topic, that first $100,000 that you've saved. Really, we want to look at how to invest it, what to do with it, what should you buy, what institution should you consider, and some of the pitfalls that you want to avoid. So we'll get into all that. Just remember out there, if you're watching, take a sec to like and subscribe. Also, if you have a question or you would like to book a no obligation consultation to chat about this or anything else that's on your mind, go to www.speaktorob.com and you'll be able to book a meeting with either Tanya or myself to chat about this or anything else. All right, so your first $100,000, you've invested, maybe you've accumulated in cash, maybe you've inherited. Congratulations if you've saved it, good for you. What are the problems that you see from time to time for people that are coming to you and saying, I got 100 grand, but I can't seem to get X? What are the things that you see?
Well, I think there's a couple of big questions that we need to ask ourselves when we get to this point, right? Before we actually run into these problems. So the first is going to be what and when. In other words, what do we want to do with this money? What is this money going to be for? And then the second thing is going to be when am I going to need this money? And so this is going to tell us our investment objectives as well as our time horizon.
Right. So if the when is retirement, obviously that's going to be long-term investments. It's going to be growth. You're going to focus on, quality names that have a long-term track record of providing consistent cash flow. But if the when is I might need it in 6 months or a year or 2 years for like a down payment on a house or something, then that's dramatically different, right?
Exactly. So you're going to need to consider a couple of things. You're going to need to consider what type of account am I going to want to invest this in? Is this going to go into an RSP, an RESP, a TFSA? Because that's all part of the what and the when. So let's say you're still in the workforce, right? You're not retired, you're earning some income. Well, you may want to consider an RSP, especially if this is for long-term money for retirement. Now, if your TFSAs aren't maxed out, that's kind of going to be a no-brainer in the sense that we'll probably want to top that up regardless of when you're going to need that money, right?
Yeah, the key is for sure for those points. If you're watching at home, and by the way, we got some really neat videos on this. Feel free to check them out. Whether or not it goes to the RSP or the TFSA is a whole other debate, but you're right. If you have a high income, if you're earning a lot of money and you have a high income and a successful job, you're likely going to want to consider an RSP contribution. If you don't, you're starting to earn a little bit of money and you're not paying a lot of tax, you're probably going to want to keep the liquidity and put it in the TFSA. So now I want to ask you about the institution and the problems that you see with individuals that are trying to get advice out there. Because not a lot, as I understand it, not a lot of individuals are out there offering advice and services of quality, I should say, for individuals that have 100 grand.
Yeah, we hear this a lot. A lot of people come to us with, issues where they're not actually able to get the long-term planning advice that they need in order to make the decisions about investing that they need. So that really has to be that first step, right? Is to look at the big picture before you start actually picking out investments. So that's the first piece. Look for someone who will offer a long-term plan to help you actually figure out what to do with these investments. So that's the first thing. The second piece is going to be to make sure that once you actually have that plan, that you have access to the types of investments that are going to be most appropriate for your situation, whether that is drawing income, whether that's going to be growth, right?
Some of the things that we see sometimes is you don't have access to all the different investments, right? And that can be problematic.
It can certainly be problematic, especially when we're looking for investments that need a certain amount of liquidity for short term. It can be difficult when you're coming from a situation where the only types of investments you've ever had are, let's say, mutual funds. There's a lot less flexibility there. And so it's something to consider if you've got this new 100 grand, what type of investment am I going to have access to?
You and I have been doing this for a very long time. We've been managing money, and I don't want to say every time, but almost every single time I see a statement from someone out there who reaches out and wants a second opinion or wants to speak to rob.com. And by the way, that individual usually goes to www.speaktorob.com to book that no obligation consultation. But when we do see this, it's almost always unequivocally plain vanilla mutual funds, and it's usually all the same. If you're at a specific bank, you will get that bank's mutual fund. If you're at a specific institution, you're going to get that institution's mutual funds. And oftentimes the client suffers. They can't control their tax situation. They don't know when they're buying and selling, and more often than not, they're getting the exact same strategy as the individual from Vancouver or Halifax or Winnipeg. There is no customization, right?
That's right. And that can be a really big issue in itself, that there is no customization. But the other piece that we find that people who come to us are struggling with is the lack of education as to what they're actually invested in, what is in those mutual funds that are invested in, and also oftentimes a lack of transparency as to, what are we paying in terms of fees. So we haven't touched on that yet, right? We should talk about this, right?
Yeah, fees are one thing that unfortunately in Canada, and probably one of the worst places on the planet for individual retail investors starting out, because the individuals that are giving advice to those starting out investors in Canada are typically getting a fairly decently high MER, a management expense ratio, and those fees are often in the 2.25, 2.5, even almost 3% sometimes for fees.
That's right. And you would imagine that you're getting something for those fees, and perhaps that's the case in certain situations, but the reality is that it's not a very flexible investment strategy. And once you start getting into that $100,000 mark, like we're discussing today, you're now getting into a territory where you should customize past, just picking a mutual fund. So the other piece that we see a lot, Rob, that I also wanted to mention coming in is that we see that people will have the exact same portfolio in each of their accounts, in their RSPs and their TFSAs and their non-registered account. They'll have
and their corporate account and their joint account and, maybe their holding company account and the RESP, same funds across the whole board.
Right.
Why is that bad?
Well, there's different tax treatments for every single type of investment. And so for example, a TFSA account, it will be, since your growth is non-taxable, you're going to want to have growth-oriented investments inside that account. In registered accounts, you're going to want to have less favorably taxed investments. And then in your non-registered accounts, you're going to want to make sure it's as tax efficient as possible, because you will need to pay tax on the income that you're going to be taking from those investments, right?
Really good advice, Tanya. That's something that is often not considered. I'm glad you brought it up. Hey, I want to get to the actual nuts and bolts of the portfolio, because I do believe a lot of people out there are wondering, all right, I got $100,000. Do I buy 10 shares of Amazon? Do I buy, one mutual fund? Do I buy just ETFs? How many names do you think a portfolio with 100,000, assuming it's one account, let's say someone's got $100,000 RRSP, how many names do you think you'd like to see in there if you were building it? And do you strictly stick to individual stocks, or would you add an ETF or two in there? And what would that look like for you?
That's a great question. And of course, I'm tempted to say it depends, because of course it depends on your risk tolerance. It depends on, the entire situation. But generally speaking, if this portfolio does have the risk tolerance to have some equities in there, I would prefer primarily to use individual stocks so that the client can save on MER fees and other types of fees. I'd like to see anywhere from a dozen to 20 or so names as far as stocks. That's going to create a well-diversified portfolio for you.
Yeah, so that's a good number.
Reduce the risk. And we would actually also recommend having some assets in that portfolio that are uncorrelated to the stock market. In other words, when there is a big market correction, a full-on crash, we need to know that some of those assets are going to be uncorrelated and are still going to be providing income or keeping those assets fairly safe for you.
Another thing that we should consider, Tanya, and I think is something that's often talked about, is your 10 or 12 or 20 names what should they look like geographically? So I think you and I have talked about this in the past and in other videos. I'm a big believer in having, maybe 5 or 6 Canadian names, a dividend stock, maybe an oil and gas stock, a manufacturer, retail, something like that. Then in the US, obviously there's a lot of tech. So you're probably going to own, 1 or 2 of the big tech names, maybe a bank, maybe a retail producer out there, a manufacturer, industrials, maybe a REIT. And then when you're looking at globally, nothing wrong with having maybe an ETF or 2. And if you want to add something like crypto, or you want to add a sector specific focus, like maybe green energy or maybe EV, or maybe you want to add, data computing or e-gaming, you can do that through an ETF. And $100,000 allows you, it's enough money that allows you to do something like that. So I think that's something we have to consider as well, wouldn't you say?
Agreed.
Yeah, check out our videos on alternative assets, on real estate investment, on music royalties. All of those are uncorrelated assets. They generate income regardless, and they are super, super good for non-registered accounts. If you happen to have a non-registered account or a corporate account, I guess the bottom line, Tanya, is it really does depend. And you might be out there saying, well, why don't I just do this myself? Why don't I just buy 5 or 10 stocks? But the reality is, when you're at $100,000, you're at the point now where you can get professional advice. So you don't need to try to wing it yourself. I've seen so many people blow themselves up in their portfolios, and it's not fun to blow yourself up. Seek professional advice. Go to www.speaktorob.com. Happy to book a no obligation consultation. Tanya, anything else you'd like to add about asset allocation or what you should do with your first $100,000 that you've saved?
The only thing I would add to that is make sure that you are 100% confident in your strategy and confident in the support that you are getting to help you come to that strategy. I think it's really important to know what you have in your portfolio and ask lots of questions.
It's very emotional. This whole process of investing is very, very emotional. And one thing I think that you are incredible at is just removing the emotion from the process. And I think it's something that we preach here. Remove the emotion, take away the emotion, make logical decisions based on facts and numbers. We've always been quite good at that. Growing up, we had a mom for an accountant, we had a dad for an investment banker, and you and I learned a lot at the kitchen table. And that, I would say, is probably one of the most important lessons we learn, is be agnostic with respect to emotions and be agnostic with respect to your money, right? Don't treat it as your money, because then you get tied to it and you make bad decisions. So I think that's really good advice that you gave there, Tanya. I want to thank you, my big sister, Tanya, for coming in today on the video and chatting about what to do with that first $100,000. Again, I'm Rob Tatro, Portfolio Manager at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group, with my sister, Tanya Tatro, who came here today to talk about what to do with your first $100,000. Take a sec to like, subscribe, and share. We'd love to hear from you. Put it in the comments below. And again, thank you for tuning in. We'll see you in the next video.